if you look at 1970, the price of gold was $35 an ounce. It's now over 1900, and it's been kind of easing off a little bit lately, and it may ease off more. But it was a reasonably good inflation hedge, considering what is the risk of owning gold. You understand? If you place it, my worry about placing money on deposits with the banks is that the banks cannot repay you one day. That is always a risk.
Marc Faber, the director of Marc Faber Limited, whose skill as an investment advisor and fund manager has left a notable imprint in finance. In this video, Faber delves into gold's historical price, its role as an inflation hedge, and concerns about government influence. Gold is a proven long-term hedge against inflation, but its performance in the short term is less convincing. The year 1971 marked the end of the gold standard and the conversion of gold into dollars. The price of gold was unrestricted. If we look at the price of gold over 10 years, we can see that the 70s were marked by a very significant rise. The price of gold rose from $35 to $850 an ounce between 1971 and 1980, in line with the oil crises, galloping inflation, and international conflicts. Faber is confident the US dollar's global reserve status will diminish over time, similar to past currency replacements like the Spanish peseta and the British pound. The US dollar now accounts for 58% of foreign exchange reserves held by overseas central banks, a record low. Gold, the most ancient widely accepted international currency, has chipped away at some of the dollar's dominance, accounting for 15% of reserves, up from 11% 5 years ago. Faber sees trade moving away from G7 countries to countries like Saudi Arabia, India, China, Brazil, and Nigeria, hinting at a slow shift away from the US dollar. The current BRICS 5 now contribute 31.5% of global GDP, while the G7 share has fallen to 30%. BRICS is expected to contribute over 50% of global GDP by 2030, with the proposed enlargement almost certainly bringing that forward. China's GDP actually overtook that of the United States in 2015 when comparing economies in purchasing parity terms. We will now bring you clips of Marc Faber from his recent interview with Commodity Culture. Before we proceed further in this video, please make sure to subscribe our channel and click the bell icon to stay updated.
That U.S. Investors experience with some regional banks. But if you have gold and you keep it in a safe in your house or in a bank or in a depository institution, it's relatively safe. The government may take it away one day. Since they managed to lock you down, they can also do all kinds of nasty things to you in the future. And since so many people seem to be in love with communism and socialism, I wish these people had lived under the Bolshevik Revolution in Russia. They would not be endorsing socialism with so much enthusiasm and always argue that the government should do this and the government should do that, when it's being proven empirically throughout history that the private sector performs better than the government sector and the bureaucracy. Well, I'm convinced that over time the importance of the US dollar as a reserve currency will diminish and eventually be eliminated. It's only a question of time. The way the Spanish peseta was eliminated and the way the British pound was eliminated as a global currency. They still exist in local currencies. But I'd say it's not going to happen overnight. But we can see increasingly the trade shifting. Say in the 1960s, 1970s, 80% of global trade went through Europe and the US, in other words, through the G7 countries. Now this has diminished, and more trade is between Saudi Arabia and India, and Saudi Arabia and China and Brazil, and China and Nigeria, and China and the rest of Africa, and so forth. So the natural development is that eventually Chinese and these countries will bypass the dollar and settle either in Chinese yuan or RMBs or in Nigerians nairas. Or this is natural, and it will happen, but it's not going to happen overnight because the world reserves are still predominantly in US dollars. But they will, as a percent of total reserves, they have diminished and they will continue to diminish, in my opinion.
During the interview, Faber assessed recent U.S. central bankers like Powell, Yellen, Bernanke, and Greenspan. He viewed Paul Volcker as the final effective one, followed by a policy change. Volcker was Fed chair between 1979 and 1987, famously breaking the back of inflation in the early 1980s by raising rates to as high as 19%. He killed inflation, but at a cost. The unemployment rate shot up to 11%, the highest since 1940 until the COVID pandemic, while inequality exploded. Faber broadened his criticism to cover the European Central Bank and Japan's monetary policy. The Bank of Japan's short-term interest rate target has been held at minus 0.1% since it first adopted negative rates in 2016 to fight chronic deflation that has plagued the Japanese economy for decades and jumpstart economic growth. It is keeping current policy to cope with growth it still sees as fragile. Let's get back to interview.
If you look back at the last few central bankers in the US, say, you had you had now Powell, before that Yellen, before that Bernanke, and before that Greenspan. And before Greenspan, in my opinion, the US had the last good central banker, which was called Paul Volcker. After him, the Fed started to print money. Had a Fed chairman who knew something about economics. That I give him credit for. He's an accomplished economist, but he became also a politician that wanted to reward the politicians, the administration, and Wall Street. And so he printed money, but not as badly as his successor, Mr. Bernanke and Miss Yellen, and so forth. And Anna Schwartz, who wrote the monetary history of the United States with Milton Friedman, she badly criticized Mr. Bernanke and his reappointment as a Fed chair because she said that he's basically a money printer and nothing else. So yes, the Fed and other central banks, so you look at the ECB in Europe, it's even a greater disaster than the Fed. Or you look at monetary policy in Japan. Now, the other day I got a report that said that real estate prices in Japan were up something like between 40 and 60% year on year for luxury properties. And inflation in Japan is, say, officially over 3%, but that doesn't reflect the reality. The true nature of inflation in Japan is higher, and it is more like 4, 5, 6%. Anyway, the interest rates on 10 years Japanese bonds is still only 0.59%. So in real terms, inflation adjusted, interest rates in Japan are still extremely negative. And whenever you have negative interest rates, you have basically an inflationary impact. Now in the US, I'd like to point out, interest rates are higher than they were 2 years ago. That destroys the demand of lower income recipients. As I explained, they struggle because the prices, the cost of living of the household is going up more than their income.
In the coming years, global currency dynamics seem poised for a transformation. The US dollar dominance as the primary reserve currency is gradually weakening, making way for alternative contenders like gold. What do you think about the changing global currency landscape and the rising importance of gold as an alternative reserve asset? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.